If I can go first, I want to focus on the word research and the investment research challenge. Ask you about the fundamental research you did on this company. How many facilities did you visit? What did you see? You mentioned well lit and clean. Are they in fact well lit and clean? And then how does that drive the forecast that you came up with in the valuation?
Yeah, we actually visited a variety of facilities. Some being from Buffalo, they're very concentrated in Buffalo. What was the second part of your question?
So what did you see at these facilities? Are they really well lit and nice? Are there rats running around the place?
Yeah.
How does that inform your valuation?
Absolutely. So when you think self-storage, you think maybe your traditional mom and pop shop in the rural landscape. Sovereign's locations are much more urban, cleaner facilities, multi-tiered. They have 24-hour security, passcodes, things of that nature. So it's much more sophisticated self-storage.
To add to that answer, we visited the corporate headquarters as well. So we talked about the revenue management system, the 24-hour call center, the web-based marketing. We actually visited each section of the business, and we were able to sit down with exactly what their marketing strategies are, how they help out their clients through the call center, and basically just saw everything that's built into this advanced revenue management system that really drives their pricing power.
I have a question about the board of directors. You really alarmed me with the comment about that. Tell me more specifically about the conflicts of interest you see there, and why would you hold such an investment?
So the conflict of interest isn't a public concern, really. That was more just us going through it and looking at, we have two board members with 20-year tenures. We think that's a little high for us. But overall, both board members have been crucial to the acquisitions that Sovereign makes. They have a variety of real estate experience and actually coincide with management's acquisition strategy. So from that standpoint, we have faith in the board.
Okay, thank you.
Can I ask you about your Monte Carlo? What sort of variance, covariance matrix did you do in your estimations?
Okay, so
5 variables, I believe.
Okay.
Yeah.
If you could go to the Monte Carlo factors. Okay, so each of these factors were built into our simulation. Basically, we had 3 main factors that drove revenue. So we had occupancy rates, total square feet, and asking rate per square foot, or sales per square foot. They're really interchangeable. So we're able to use historical information and historical standard deviations to figure out exactly what range that we want, and then our assumptions and our analysis of the macroeconomic environment really led us to our growth rates through acquisitions, through pricing power, through occupancy rates. To go into more detail, the most sensitive input here that you see is the terminal cap rate. That is because the terminal cap rate was used to drive the terminal value of the company. So variation in this cap rate led to changes in prices in the model. But no matter how we adjusted the model for a specific cap rate, between 5 and 7%, we still were a hold.
Hi.
Hello.
My question deals with the fact that you've signaled that there was a kind of a geographical concentration within the properties that the company has, and I don't see these kind of unsystematic factors put into the discount rate.
I'll take that. I'll take that one. I'm just going to pull up a slide real quick.
Okay.
So you don't see how this could have been built in quantitatively, is that what you're saying?
Yes.
So it was tough to build this in quantitatively because we have to look at this from a risk perspective, but oil is also possibly a benefit for Sovereign. So I'll explain what I mean. If you're looking at this from a benefit perspective, which Sovereign hasn't made any drastic moves yet with Texas, if oil is a short-term problem, that's a benefit for self-storage. If you need to go get a job for another 6 months while oil does what it needs to do and it starts coming back up, you're gonna see people coming back. So if you're just gonna leave your stuff for 6 months, it could be a benefit for self-storage. If it's a long-term issue and we consistently see low oil prices, we see it steadying out, Sovereign's gonna consider taking action that would help, hedge themselves against the density that's no longer gonna be there in Texas. So again, long-term issue, it's a problem. Short-term might be a benefit. So in building that quantitatively into the model, there's two major things that go into Sovereign's pricing. One is that revenue management system we keep mentioning, which takes into account when there's high churn in a certain area, their pricing is going to adjust downward. If they're seeing low occupancy rates, pricing will adjust, marketing will increase, things like that. So quantitatively, it's really built into their management system, into the revenue build. And then the Monte Carlo simulation really is kind of our fail-safe, given that it's generating 10,000 simulations. So any change in cap rate in the overall structure of the company, that's being taken into consideration. So we didn't feel we needed to literally put a number directly into the model, more so understand what's going to happen and what are the potential outcomes.
Thanks.
Welcome.
It wasn't clear from your presentation how much of their growth and what you're forecasting for revenue comes from just macroeconomic factors, just being there, and macroeconomic factors are going to drive demand, and how much comes from their competitive advantage versus, a customer choosing their storage center versus other storage centers, and how do they stack up versus the competition?
Okay, so we've seen increases. Both of those factors that you mentioned are primarily driven by their asking rate per square foot. And we've seen drastic increases in over the past 2 years, 2013 and 14, of over 9%. And basically, the management team has stressed this over and over again, that this is really due to limited supply. So there's the supply in the market has grown between 1% and 2% each of the past 5 years. So as these demand characteristics that we mentioned before, the aging baby boomers, the jolts running up, basically people are moving, people are getting more confident, they're buying more things. All of these things are built in primarily, it's the primary assumption that's built into the asking rate per square foot growth. And then basically, to hit on the other part, basically the next generation storage is just kind of like a cherry on top. So we see these great macroeconomic tailwinds that's really going to drive up the ability of them to charge more, and that they're going to choose Sovereign, and they're going to keep their occupancy rates up because their storage facilities are nicer.
And these four big players account for only 10% of this market, just to drive that home. What separates them is more from these mom and pop shops. This revenue management system, they're able to outsource this to a company called Veritech Solution, which takes 10 years of historical info and 7 key factors, including competitors in the 5 to 10 mile radius, what's the anticipatory occupancy rates, and their call center traffic. Sovereign Self-Storage is the only 24-hour call center. So your mom and pop shops, the majority of the industry, cannot do this. So they do have a competitive advantage there.
I have a question going back to the Monte Carlo distribution. It was non-normal. Can you tell me the factors that led to that result?
Okay, so basically, certain things that skewed the Monte Carlo simulation to not be a normal distribution was the fact that we had a cap on occupancy rates. So our belief is that Sovereign will not be able to drive occupancy rates up above 91%. And based on the last 10 years of historical data, we have a 2% standard deviation. So if you think of a normal distribution, 95% of the outcomes would basically go up to 95% occupancy rate. But we believe that Sovereign will not be able to get above the 93.5% occupancy rate that public storage currently has. Public storage is the Goliath in the industry, and basically Sovereign will not reach the size and basically the breadth of public storage to be able to drive their occupancy rates higher than 93% in any situation.
To follow up, should that have skewed your distribution in the other direction?
Well, we also have to consider, we put a cap on the cap rate as well, and which is a much more...
But aren't those good things?
The higher the cap rate, good things? No, the higher the cap rate go. Oh yes, putting a cap on it would be beneficial because it can't go any higher. However, we had to consider that there's no direct information that we could get for self-storage REITs in terms of cap rates. So we had to build in REIT cap rates and then adjust it to match self-storage, which the industry supply is growing at a different rate than REITs in general. So the variation in that factor causes, I guess, not the skew you're asking about, but this distribution.
So these two beneficial things really caused our possible sell intrinsic values that you see in the red to be a lot smaller than our possible buy situations that you see in green.
Right.
Tell me, what factors might consider you to rate a sell on this stock?
The main factor that really drives real estate investment trusts in general are cap rates. So if we see a... Okay.
Thank you.